Good afternoon, everybody. Welcome to the session. Our speaker, Lynn, is in the room. We are ready for an on-time start. We're starting at 4 p.m. Eastern, about 4 minutes or so, because the last session is just ending. I see people coming in now. Just sit tight, and we're going to get started momentarily. Thanks so much for joining the session with us. Good afternoon, everybody. Welcome to the session. Lynn is in the room. We are ready for an on-time start at 4 p.m. Eastern, which is in about literally 2 minutes or a little less. So just sit tight, and we're going to get started momentarily. Thanks again for joining us. Good afternoon, everybody, and welcome to the session. I'm your host, Joe. A couple of bits of housekeeping. We'll jump right into Lynn's presentation. Two things. Thank you, obviously, for participating in the virtual shows and the face-to-face events. We love having you. Please keep that feedback coming so we get better and better. Secondly, Lynn is going to take some questions at the end of the presentation, time permitting. We're going from 4 to 4:30 Eastern. You'll see a chat box if you're just watching us for the first time. As you're watching Lynn to the right, there's a little chat box. You can actually send questions over, so please don't hesitate. Send those over. And again, time permitting, we'll get to as many as we can. With that said, it's my great pleasure to introduce everybody to Lynn Alden. Lynn, great to have you back. Lynn is the founder of Lynn Alden Investment Strategy and is a contributing analyst to ElliottWaveTrader.net, covering equities and alternative investments. And with a background blending engineering and finance, Lynn blends fundamental research with a global macro overlay to find opportunities in markets around the world. Lynn is also the author of Broken Money: Why Our Financial System is Failing and How We Can Make it Better. Lynn, great to have you back. Thank you very much. And the floor is yours.
Thank you for having me, and thank you for everyone for coming. So I'm going to talk about fiscal dominance and how this impacts our investing strategies going forward. It's a topic that I've covered a number of times recently. It continues to be the number one kind of backdrop that I use as like a North Star for investing. And so updates on the thesis and how things are going always seem to be in demand. So let's get started. Fiscal dominance. What makes it different than what we're normally associated with over the long term is that basically the whole kind of investment cycle is heavily impacted by fiscal deficits in a way that is historically not common on a sustained basis. The opposite environment of fiscal dominance is monetary dominance, meaning that the Fed and the banking system are kind of predominantly impacting the overall cycle. And one kind of simple metric to look at is to look at the fiscal deficit as a percentage of GDP in relation to the unemployment rate. Historically, these two were very correlated, as you can see on the chart on the screen. Outside of the Vietnam War in the late 60s, which was a very brief dislocation, these have pretty much always been in sync, meaning that higher unemployment will get you higher deficits and vice versa. What we saw since the middle of the 2010s decade, really since 2016, 2017, is a decoupling where fiscal deficits as a share of GDP have risen to historically high levels, while unemployment is still low. And this was pre-COVID, this was post-COVID, and so even outside of that kind of brief, pandemic lockdown, hyper stimulus environment, this is already happening and is on a sustained basis. And we'll get into the reasons why. But that's kind of the first thing to know is that, people have been talking about debts and deficits for decades. That is true. But we have kind of entered a new environment now, where things are indeed different, and therefore have different economic implications and investment implications that are important to be aware of. And I've been covering this topic in different capacities for about 5 years, which was closer to the start of this. I started covering it back in maybe 2019 or so, kind of hinting at it earlier in maybe 2018, which was a handful of years after this started becoming a sustained thing. And it really was, kind of post-COVID that sort of kicked it into overdrive, but the seeds were already there. So the second chart here is like a snapshot of why this matters from an investing standpoint. And what I have here is a chart of gold prices as of a couple months ago, and real rates inverted. And real rates in this capacity basically compares forward break evens, compared to CPI. And historically, these have had a very strong inverse correlation, meaning that when real rates are low, gold tends to be highly priced. And when real rates are pretty high, gold tends to be sold off and go down or is not having great performance. And the reason for that is pretty intuitive. If investors perceive that they're going to get high real rates on their cash and their bonds, meaning that their interest rate is going to kind of keep up with their expected inflation, um, then they're more likely to hold dollars and hold those kind of paper assets, and maybe sell their gold. On the other hand, if they perceive that they're not going to get compensated with enough interest to cover their expected inflation and debasement, they look at gold and say, well, gold only has on average a 1.5% annual supply growth rate. It doesn't pay you a yield, but that's kind of the hurdle rate that you're comparing dollars to. And so if dollars are going to not pay you almost anything and they're going to inflate at a supply growth rate of 7%, people pile into gold. Now, what's interesting is that in the recent 3 years or so, this relationship totally decoupled, where we got pretty high real rates. So remember, this is inverted. So, when the Fed jacked rates up well over 4%, most historical models would say that gold would have a tough time in that environment. And quite the contrary, gold broke out to all-time highs comfortably. And it's been consolidating lately, but it's holding up very well. Similarly, if you asked people a few years ago, would you expect Bitcoin to be well over $100,000 dollars per coin with interest rates over 4%? Most people would have said no. It's mostly a zero interest rate phenomenon, and yet here we are. Equities are at all-time highs, gold's near all-time highs, Bitcoin's near all-time highs, despite the fact that the Fed's been trying to be pretty hawkish. And that kind of touches on fiscal dominance. During fiscal dominance, interest rates are less effective at curtailing overall credit creation and asset prices as they are in monetary dominance for reasons I'll get to in these coming slides. So what this chart shows, there's two charts showing the same thing. The one on the left is 1955 to 1990, and the one on the right is 1990 to the present. So this covers about 70 years of data. And the blue lines on both charts are private sector debt growth year over year in dollar terms. And the red line is public sector debt growth, basically the federal government debt. And what you generally see is that historically, so for most of this period, kind of pre-global financial crisis, normally private sector credit grew faster than public sector, meaning the blue line was higher than the red. And there'd be brief exceptions, kind of in the aftermath of certain recessions, because deficits would go up and lending activity would decrease. But what we've seen, the global financial crisis really kind of had the biggest ever dislocation where public sector debt had a huge surge, while private debt growth had kind of the unprecedented level of slowdown not seen since the Great Depression. But then again, in recent years, we had a total decoupling where on the longest period of time in modern history, uh, the amount of new public debt in a given year in the US exceeds the private sector consistently. And that's before and after, say, the COVID lockdown recessions. So that was happening pre-2020 and it's happening now. And if you remember from this earlier slide, it roughly correlates to this time period. So roughly since the mid 2010s, with a little bit of a lag, we started to see this play out, where despite having no recession, we're still having public sector debt growth exceed private sector debt growth. And what that means, generally speaking, is that Federal Reserve interest rate policies are less effective at curtailing credit growth because back in the 70s, so back in this period here where private sector debt growth was responsible for the majority of new money creation, federal debt was pretty low as a percentage of GDP. It was only about 35%, even lower at the lowest point. And what that meant is that when the Federal Reserve jacked up interest rates super high to try to curtail borrowing and curtail money supply growth, it was effective because even though they did blow out the deficit by increasing federal interest expense, they slowed down bank lending by a much larger amount. And they basically put the economy into a recession and cooled off inflation. The problem is that when you have very high existing public debt, so well over 100% of GDP debt, um, and banks aren't lending super quickly, if the Federal Reserve tries to increase interest rates to slow down inflation and credit growth, they actually blow out the federal debt with interest expense at a faster rate than they slow down private sector bank lending. So they don't really have the ability to slow down total credit growth anymore. And so you get these kind of weirder economic environments that really only happen in fiscal dominance when you build up decades of accumulated deficits and therefore have a very high public stock of debt. And so that's kind of the inverse situation we find ourselves in fiscal dominance as opposed to monetary dominance. So we can look at a couple catalysts for why is this happening now? Like why are these green boxes on the right here happening? Why is this decoupling happening? Kind of starting in the late 2010s. And there's a couple main things. One is that we've run out of the interest rate channel, and so for about 4 decades we had rising debt to GDP, but we had falling interest rates. And if you double your debt, but you cut your interest rate in half, for example, your interest expense is unchanged. And so, especially as a percentage of GDP, we kept interest expense very manageable because we were always offsetting that rising debt with falling interest rates. Problem is, the whole Western world pretty much hit zero. Europe and Japan partially went negative. The U.S. got just very compressed near zero. And so going forward, if we merely chop sideways in terms of interest rates between, 2 and 5% for the foreseeable future, we no longer have the structurally declining offset. It's really hard to kind of go well below zero because you start to compete with just cash. and people will flock into gold and Bitcoin and other assets. So um, if they just merely chop along sideways now, we don't have that offset anymore. So when you have rising debt to GDP, but you don't have that interest rate offset, you start to actually get interest expense being really serious. And at the current time, for the first time in history, the U.S. is paying out more on its interest expense than it is on its entire military, which is generally not a thriving situation for an empire to find itself in. If you look back in history, another big catalyst is demographics. And this is actually a really key reason why that decoupling started happening in the late 2010s. So if, this is the Social Security Trust surplus. And so, for many decades, part of each paycheck goes into the Social Security Trust, and then as people retire, they get checks from that trust. So they always have money going in and going out. But during most of its history, demographics were favorable, and more money was flowing into the trust than out of the trust. But as the baby boomer generation, which is a historically large generation, has increasingly entered their retirement years and a greater share of them become retired, we've entered a period of time where Social Security is paying out more than it's getting in from paychecks. Another way of thinking about this is that the ratio of retirees living off Social Security to workers paying into it has decreased over time, and it reached kind of the flip over point. And as you can see, this started to happen in the late 2010s. We kind of no longer were increasing on this. Now we're in drawdown mode, and this by drawing down comes out in the form of the deficit. We end up spending it back into the economy at a faster rate than we're taking it out. And by the Social Security Administration's own forecast, they expect by around 2035 this will be depleted. So this 3 trillion in cumulative surplus will have spent into the economy. And of course, the actual dollar figures per year are bigger than that because they still do have receipts and they still do have interest from their intra-government Treasury security holdings. But the point is the combination of no longer having declining interest rates and having aging demographics basically means we're spending way more into the economy than we're pulling out of it. And so regardless of the unemployment cycle, we're running structurally high fiscal deficits. And while this may seem like a new environment, and it is in kind of our investing horizons, or even depending on how old you are, your parents' investing time horizons, anyone who's been alive and made a career out of investing has mostly been in a period of monetary dominance. When we go back in history, and also when we look at emerging markets, we can see other periods of fiscal dominance that we can learn from. In the United States, the last time this happened was the 1940s. And some investors, such as Ray Dalio of Bridgewater and others, popularized the concept of the long-term debt cycle, which I think is one of the most instructive things to understand for this investment time horizon. And basically, what that kind of shows is that you have a period of rising debt. You get more and more private sector debt growth, and eventually you get to a very high level, and you hit zero interest rates. And so, every kind of recession, anytime you're trying to keep the debt Ponzi growing, they cut interest rates. That allows debt to keep accumulating, and they kind of go lower and lower each time until they hit zero. And then they find out that even cutting to zero doesn't stop the debt Ponzi from unraveling. And so what tends to happen is that private sector does deleverage to some degree. So this is an orange here, we have private sector debt as relation to GDP. And what we generally do historically is we rotate it onto the public sector. So as the private sector deleverages, we lever up the public sector. And so we did this, and this was 1929, and this was 2008. So both times that happened, we hit zero interest rates for the first time in like a very long time, and we started to increase the monetary base as a percentage of GDP, basically printing base layer money in various ways. The term QE did not exist back in the 30s and 40s, but that's essentially what was happening. And of course, we have QE today, where the Federal Reserve can just increase base money and buy assets with it. And so what we just start to do is we start to rotate the private sector debt onto the public ledger. And that's where we get, for example, if we go back here, upticks in debt pretty significantly. That really started to happen after the global financial crisis, and of course happened again after COVID. And this is in relation to GDP. So it's happening, of course, considerably in absolute terms. but then even relative to the size of the economy. And one of the key differences is that a when a private sector debt bubble starts to unravel, that tends to be pretty disinflationary. So the 1930s were, if anything, they were outright deflationary, and the 2010s were kind of known as a period of lower average inflation. And However, when you start to get to a public sector debt bubble unraveling, that tends to be more inflationary. That kind of monetized fiscal dominance environment tends to have a more inflationary kick to it. So the 1940s were way more inflationary than the 1930s. Of course, there was a war going on, but behind that war was this massive injection of money printing and fiscal activity. And if you asked me a few years ago, what does the current situation look like macro-wise? The response to the pandemic lockdown looked a lot like war finance. And I kept saying at the time, it looks a lot like the 1940s, but hopefully without the kinetic aspect. Now, eventually, what's going on in Ukraine and stuff, eventually we did get some kinetic aspects, unfortunately. But even before then, it just we're in a more wartime finance situation, which historically happens when you get into fiscal dominance. Basically, any sort of private sector debt deleveraging gets offset onto the public ledger, and you generally enter a more polarized political environment. Generally, a more command and control type of economy. So back in this era, of course, there's FDR, and today, we're talking about national trade deals. We have the government has like golden shares in certain in steel company acquisitions. We kind of have a more command and control way of looking at the economy than historically has been under a period of monetary dominance. And so that changes the investing landscape. Uh, One of the more recent questions I get in the relation to this whole topic is the impact or lack thereof of tariffs. Um, and so it helps really kind of quantify to what extent tariffs could change or alter this equation. And the short answer is that based on current data, we don't really see that import prices are in aggregate going down, meaning that the majority of the tariffs are being paid by some combination of American businesses and American consumers for the most part, with foreign exporters not really taking a big share of that. That could change in the future, but those are the current situations. And the U.S. does something like 3.2 trillion in annual goods imports, so physical goods. And if we have an average tariff rate of 15 to 20% on that, that raises 500 plus billion in new tax revenue. Again, mostly from Americans. Now that's in relation to the fact that the federal government currently spends over $7 trillion a year annualized into the economy, and the tax receipts are a little over 5 trillion a year, meaning that we're running somewhere in the ballpark of a $2 trillion annual deficit. So if you add 500 billion in new tax revenue, you potentially collapse that fiscal deficit by about one quarter. Now, that's not always linear. It's unlikely to be linear because if you do a big tax increase, that can slow down the economy. It's too early to say, but recent data showed slower than expected job growth. We also see the ISM PMI numbers are showing generally higher prices and lower activity, especially in the manufacturing sector. So we'll see how that data unfolds. But generally speaking, uh, even the tariff revenue is hard to make a dent in the size of the ongoing fiscal dominance that's happening. And so basically, we're in this more run it hot type of environment. And what does this mean for investing implications at the big scale? A couple main things. One is that cycles tend to be smaller and the overall thing tends to run hot. And what I mean by that is, when we look at the private sector credit growth, right, it tends to be, it rises during expansions, contracts during recessions, rises, falls. Whereas the federal spending is not very sensitive to the economic cycle. It's not as though people get their Social Security checks cut just because we're in a recession. It's not as though Medicare spending goes down just because we're in a recession. Defense, again, largely uncoupled from the economic cycle. And so when you have a larger share of the economy coming from that federal spending side, that tends to be less cyclical and kind of, you know, raises the floor in a nominal sense of what happens during cycles. Um, and so you end up more in a run it hot type of environment. If you ever look at emerging markets in a recession, they tend to have a somewhat more stagflationary or inflationary type of environment, and that's generally speaking also what happens to developed markets when they enter fiscal dominance is that when they do have some sort of downturn, it tends to be less disinflationary, less of a bust, and more of a malaise. And so that's one thing to kind of keep in mind investing wise. Another one is that structurally, and this is true in all environments, but it especially becomes kind of accelerated in fiscal dominance, is that you want to own scarcity and short fiat. You want to short fiat because it's not scarce, and you want to own things that are scarce. Um, and so, a lot of people are surprised by the resilience of the stock market, for example, in the face of rather hawkish Fed and the economy that's kind of running on two speeds. A lot of it happens to be because corporations are doing exactly this. A lot of corporations took out long duration debt. They borrowed, Apple would borrow paper at 2% for 20 years and just lock that in and buy back, their own stock with it. And so you have a lot of blue chip companies out there with long duration, low interest rate debt. They've locked it in. So they're not really vulnerable to the recent Fed rate hikes. Same thing for a lot of homeowners. Many people own their homes free and clear. A lot of people that do have mortgages have locked them in years ago. And so the economy kind of finds itself in aggregate pretty resilient against the rise of short-term rates because such a large portion of private sector debt is locked out longer term. Um, and so many equities remain very attractive in this environment, as long as you kind of pay attention to excessive valuations and avoid those. It also generally means that you want to own things like gold or Bitcoin rather than bonds. So bonds have had 5 years of pretty disastrous performance compared to almost any other asset. Um, I would expect that the rate of that is likely to decrease, meaning that I don't think the gap will be as big over the next 5 years. But it continues to be the case that just bonds are not particularly attractive during a period of fiscal dominance because your part of the equation is inflating those away, um, especially relative to the scarcest assets. So, if we get way more productive, if we get, over history, we've gotten way better at, say, making software, making computers, making other electronics, making grains. Our engineering and our productivity keeps going up, which offsets some of the money printing. But we don't really get much better at making fine art like historical fine art, waterfront property, gold, Bitcoin. There are certain things that no matter how much better we get at engineering, we don't really make those things, if at all, more than we used to. And even now, in the age of AI, where we might be able to increasingly cheapen the cost of certain types of white collar functions, and therefore increase the supply of white collar type activity from our AI friends, um, that can offset some measures of CPI because, for example, accounting services could be cheaper, programming services could be cheaper, for example, because there's more abundance there. But that still doesn't tackle the truly scarce things that you generally want to own. High quality properties, the highest quality food, high quality medical care, and monetary type of assets like gold, Bitcoin, as well as historically scarce assets like fine art. So you generally always want to keep erring toward own scarcity and where possible, short fiat. That's also why we've seen the rise of like Bitcoin treasury companies as of late. Most people, if you ask them what's the best performing stock over the past 5 years, they'd probably say Nvidia. MicroStrategy is actually like the only stock out there that's outperformed Nvidia,
Hmm.
and they pretty much just did it by buying Bitcoin and attaching some dollar shorts to it in the form of 5 year convertible debt and now preferreds. Um, it also, last point is that I'm bullish on global assets in general, and so there are some assets that are more local. So um, property in a given country, or equities that are mostly just held by the local population. And right now, there's a historically large percentage of global capital that's liquid is stuffed into the U.S. We've had the best tech sector. We've had the most kind of conducive environment for corporations for the past decade and a half. And the problem is like everyone's kind of on one side of the boat. Valuations are fairly rich. And some of these big tech companies are increasingly ramping up their capex on hardware spending for the AI age. And it's not clear yet that all of them are going to monetize that level of capex. OpenAI, for example, is still unprofitable and forecasts that they're going to be unprofitable through 2028 and beyond. So consumers are benefiting from all this AI technology. It's still not fully clear where the profits are going to land, despite the fact that it's clear where the capex is going to be coming from. Um, Now, there are other assets that are buyable globally and generally have a global price. And so gold and Bitcoin are examples of those. They're not tethered to any one country. They're free floating liquid assets that are generally fungible but across borders. It also generally means that I think there's opportunities in emerging market equities. Right now there's very little interest in investing in Brazil, very little interest in investing in China, very little interest in investing in Southeast Asia, other parts of Latin America. Um, but a number of those places I think are historically cheap. And some of them have stopped going down relative to U.S. stocks. There's been this kind of long period of them underperforming. And depending on which market you look at, they are starting to hold up somewhat better. And so I do think that those areas will be places to watch in the coming years, especially as we are likely going to be entering a cycle of lower interest rates, either because we have a mildly decelerating U.S. economy, or perhaps because we politicize interest rates and we find ways to get them lower. That will generally, on average, benefit emerging markets because a lot of central banks around the world have tightened their policy to try to make it so that their currency is not losing too much value relative to the dollar. And so, and short-term rates are one of the key factors there. So as the U.S. brings down its short-term rates, that gives more leeway for emerging markets to ease as well. So that ends my prepared talks. I'm happy to take questions on the broad subject. Thank you.
Thank you, Lynn. Very awesome presentation. But on the emerging markets, mention those areas again. You said Brazil, China,
Yeah,
Southeast
yeah.
Asia, other areas that are attractive. Was there any others that you mentioned?
There are parts of Eastern Europe that are attractive as well. Poland, for example. Generally speaking, there are places with cash flows that are very attractive. I'm using Brazil as an example because right now most of the headlines are negative, um, but I argue that they're priced for it. So, for example, right now Brazil's the target of some of the highest tariff rates in the world by the U.S. But we're talking about a $2+ trillion economy with something around 40 billion in annual exports to the US. Many of those are commodities that could be redirected elsewhere. It's a small share of GDP. It's not trivial, but it's a smallish share of GDP. They could certainly withstand them, and they're underowned, very cheap, and they have some of the more hawkish policy out there because they kind of have to. Um, and so I think there's multiple pockets in the world that are attractive.
T-Bone's asking, Len, you mentioned being bullish on global assets, obviously gold, Bitcoin, emerging markets. I'm sort of interpreting this as an expectation of higher inflation for longer. Wouldn't that find its way into U.S. equities? And also, wouldn't the U.S. Issues affect the world bringing cash to U.S. equities as well?
To some extent, one of the challenges is like, in the US, there's like Costco trading at 50 times earnings. And for example, while I do expect Costco's underlying fundamentals to do well, you could have some degree of earnings compression where you go from 50 times earnings to 30 times earnings, for example, on an otherwise great company. Um, and there's a number of kind of big entities in the US that have that issue. Whereas in a lot of other markets, you can buy things at 8 times earnings that are growing. And you pay a little bit more volatility for them because the world doesn't kind of just get into those as easily. Um, but I think there's an opportunity there. In addition, I generally find U.S. financials to be more interesting than average. A lot of people are concerned around them due to the possibility of recession. But generally speaking, banks and insurance companies are very well capitalized. And I think they'll benefit over the next several years from this fiscally dominant environment. And I would only kind of pull that back if we do a number of top-down policies that go after the banks pretty significantly, which I think they're currently protected from.
Thank you. Are you bullish on silver, platinum, and palladium at all?
So I follow silver and platinum. I am longer term bullish. I made a joke with my some of my research clients. Like platinum was the dog in my portfolio for a while. I held platinum for years, and it was always kind of disappointing. It finally showed signs of life. I am bullish on them. I do think that assets like Bitcoin, because of its volatility, has taken some of the thunder out of some of the more volatile aspects of the precious metal ecosystem. So silver, platinum, and miners. Um, some people argue that Bitcoin can eat into gold. I don't really see signs of that because gold is a lower volatility asset that even sovereigns hold, whereas silver, platinum, and miners are often traded by retail investors that
Mm.
seek that higher volatility. And I do think that Bitcoin, and to some extent broader crypto, has fractured that market, which makes that more challenging. But I do like the broad precious metals uh, across the board.
Terrific. Last question is, what are your thoughts on how the Fed maneuvers here over the next 6 to 18 months for the next year and a half? What do you think the best case is scenario for how the Fed plays this? Do you think it's a lot lower rates, or what's your thoughts?
I expect gradual rate cuts going forward. We'll see, economics data can change rapidly. It tends to be that the things move faster up and down than the market expects. My expectation is we'll see gradual rate cuts, late this year and then into next year. And it's also the challenge that because we're in fiscal dominance. It matters less what the Fed does because right now and throughout this entire cycle, it's not bank lending that's driving a lot of the money supply growth. It's really been that kind of fiscal side, which is largely immune to changes in interest rates. And so really the Fed's kind of got no great answers here. But I do think they'll be at least moderately lower over the next 12 to 18 months.
Excellent. Well, Lynn, we want to thank you very much. Great presentation, a lot of great questions, and a great audience for sure. We appreciate you for coming back to Money Show, and folks, we appreciate you guys for joining the session. Lynn, have a great rest of your day and rest of your week. We thank you again at Money for the Money Show team. Folks, enjoy the rest of the sessions today and tomorrow, and we'll see you again soon. Thank you
Thank,
again, Lynn. We appreciate you.
thank you.
Take care.